Bank earnings come in strong and seasonal tailwinds take stocks higher. S&P rallies back into the long gamma zone as the VIX index gets crushed. And UK rates are in the spotlight as Goldman's and JP expect a hike next month. All this and more in this week's Macro Insight. Welcome back, everyone, to Macro Insight. Today is the 19th of October, and let's have a look at these markets. So what happened last week? We had retail sales data that was pretty strong on Friday, beating expectations significantly, came in at plus 0.7 versus minus 0.2 expected. Consumer sentiment, however, sort of was more weak at 71.4, so a bit of a counterbalance there. Obviously, the big thing last week was bank earnings. You had all the big banks with their earnings, and in general, they kind of came out of earnings pretty good, all kind of beating expectations. The way they beat expectations a lot of the time, though, is big, reserve releases and things like that. Loan growth data didn't look amazing across the board, but the stocks rallied, right? So financials finished the week up roughly 2% as the XLF. Equity market in general, obviously, we had been getting a bit more nervous with so many signs of stagflation popping up, but the bond auctions were well received, as I had suspected they would be, with the Japanese buyers finding these high yields fairly attractive. And therefore, we did get our pullback in long end rates, right? So long end yield pulled back a bit, but the short end of the curve after the CPI number continued to go up. So we saw a pretty massive flattening of the yield curve. And then that pullback in long rates triggered a fairly impressive rally in the growth stocks with the NASDAQ up around 4.5%. Yeah. So we have a look at a few of these charts. So probably the best sort of charts on that have been put out by Goldman's, I believe. So you can see here, so they look back at 1985 to 2019, so they exclude 2008, obviously a bit of an anomaly kind of year. Take that out of the equation and you see a pretty strong seasonality across all the major US indices that kicks in around sort of middle to late October into year end. We could expect potentially 5 to 8% rallies coming out of S&P, NASDAQ, etc. Right? So that's what the seasonality would suggest, going back to 1985. All right. You could also go back even further, look at the S&P, and you can see here, potentially a move from 99 up to about 3 to 4% rally potentially expected, going back to quite a rich data set there. And right now we're on that red line. That's where we are, middle of October. And, coming out of October, you've got the corporate buyback window opening up again. And we know that corporate buybacks are a strong marginal buyer of stocks. They're price insensitive, and that's definitely got the potential to fuel a bit of a move higher in stocks, right? So seasonality tailwind definitely there for equities. Yeah. Now, also the story being spun on Wall Street, the bullish story, other reasons why we might rally or have a melt up, as they love to call it, things like exposures being pretty light. Obviously, people got a bit nervous on some of the stuff they were seeing regarding, price increases. So discretionary exposures are a bit light. Multiples and earnings expectations have compressed going into this earnings season, and we are coming out with beats. The Fed remains accommodative, even if they taper. It's still only a taper. They're still going to be buying. Also, as volatility comes down, systematic buyers such as vol control and CTA type strategies will be buyers. They have been buying, and they're likely to buy a lot more if markets remain sanguine and don't really move too much. That's going to fuel more buying from these type of systematic guys. And like we said, corporate buybacks are coming back in November. Also, hedge funds have upped their exposure to S&P futures. as that year-end chase kind of begins, right? If they've been lacking a bit, if they've kind of underperformed the benchmark, then they're going to try and press it into year-end to get back some of that performance, basically. And then finally, you know, the retail guys, the retail buy the dip mentality is alive and well. And you can see that here. Some charts out by Morgan Stanley, I believe. Yep. Morgan Stanley came here. So estimated daily retail flows still pretty healthy, looking like 1 billion monthly daily retail buys versus sells. You've got ETF flows, you know, cumulative flows, pretty much going in a straight line. And what they've done is they've done an interesting sort of analysis on the retail buying on up days and down days on the S&P. So what you're finding actually that retail aren't chasing up days, they're actually more comfortable and they buy more on down days. So it's very much a buy the dip mentality that you're seeing, and they've got data around that with that regression, and they're kind of seeing that mentality from retail hasn't gone away. That buy the dip mentality is very evident basically in the flows that they're seeing from retail. Yeah. So these are all things that are pretty supportive, I would say, for the next couple of months. The only slight concerns, you know, that are popping up on my radar would be, you know, normally when you see such a dramatic move in short-term rates, like we're seeing, for example, EDZ2, the Eurodollar futures, you know, that's priced in, you know, an extra, that's a hike basically, right? 25 basis points in short order. And often when you see those sharp sort of moves in the interest rate futures pricing, then that often leads to a bit of a volatility spike. So far we've had the VIX get smacked back down recently, but we've seen that move down in rates, or that move up in rates, sorry, and down in interest rate futures, and yet we're not seeing a vol spike on the back of that. So for now, the market seems to be relatively comfortable with the monetary tightening that's being priced in to the rates curve, right? I do think the stagflation concerns will likely resurface. We had, you know, that move down to those sort of key support areas a couple of weeks back, held that level, and now staged a strong rally back up to the top of the Bollinger Band. So it looks a little bit overbought up here. We got that bullish momentum divergence, which proved to be a good signal to buy the dip. And we're back up here. Now, this region around 4,500 is being touted as, you know, an area where the street is very long again, basically. Okay, so that we talked about the volatility supply that often comes in expiry week, could potentially trigger a collapse in the VIX. That's exactly what we saw, right? So we saw the VIX get absolutely hammered last week, you know, from 20 odd down to 16. And obviously what happens as vol comes down so dramatically, the put premium, say clients have bought a load of puts from dealers are short those puts. You smash the vol to the extent that you did last week, those puts evaporate and they drop in premium, and they also drop in their delta. So the delta that all these dealers are short against those puts to hedge them, they don't need to be short as much delta because those puts are shrinking. Okay, so they need to cover that delta and they need to buy that delta back. That's called the effect of Vanna, and also through the time decay of those puts, that's charm. So those effects basically make dealers need to buy futures on the S&P against being short all that downside that is getting creamed as the vol's going down, basically, right? So that effect drives the market higher. That's what we saw happen last week as those put premiums got crushed. And you know, VIX now back down to 16 is looking relatively low. Bottom end of the range was around 15, 16. But the problem with that is if you look at where the VIX futures are, obviously the front is collapsed to 16.5 because that contract expires tomorrow, which is the October contract. But you look along to the next contract, which is November, that's at 19.5 still. So 19.5 versus a VIX spot of 16, that's a 3.5 vol premium. It's around 15 odd percent. That's quite a hefty premium, right? So there's still going to be a risk of that thing rolling down pretty dramatically in the next few weeks if realized vol can stabilize. Okay. On that realized vol front, you know, we would expect realized vol to stabilize because like I said, we've moved into an area where the street is likely pretty long gamma. So this one's courtesy of tier 1 alpha, I believe. And so this shows you, you know, where the dealer gamma exposure lies. it shows you where the big strikes are. And basically 4,500 is where there seems to be a large concentration of long gamma for the dealers, right? So the flip point to the downside where the dealers lose all their gamma again is around 4,400, maybe 4,420 it's moved up to. But around here, and between 45 and 45.50 is where the peak of the long gamma seems to be. And so that's likely to put a bit of pressure on realized vol as dealers do their usual hedging activity, which kind of compresses realized vol. Okay, so that's kind of the setup we're likely going into, certainly for the next couple of weeks, I would say. Yeah. Okay. So that's where I am in terms of sort of the vol setup and the positioning setup. If we look at the sector breakdown. So if I bring up this chart, you can see what's being priced now for UK rates. So you've got the base rate here at 10 basis points in Bank of England base rate. And this MPC overnight interest rate swap, this is basically the market's prediction of where rates will be at various points in the future. And you can see that by sort of middle to end of next year, they've got rates from 0 to 1%. So the market's pricing in about 4 hikes, basically. Right, it's pretty aggressive. JP Morgan and Goldman's are coming out saying first rate hikes happening next month in November. So a wild shift. And if you look, we've been talking about US rates rallying, US yields rallying, 2-year yields have jumped quite a bit, but look at that, compare that to what the UK's done. I mean, it's blown it out of the water, right? So a major dramatic shift in rate hike expectations in the UK, led by what the Bank of England have been saying regards to combating inflation. But, the problem is that inflation is being all supply led, right? So the energy crunch, inflation, whatever, 6-7%, that's a problem. But if they go and hike rates to the degree that the market is pricing in, that could give us a real problem on growth in the UK and throw us into recession. So I'm not sure I think the market might have overpriced this. We'll see how it plays out, but I think the sterling move, the FX move in sterling, if we have a look at that, it's probably a little bit overdone in the short term. And I think fading it, maybe not against the dollar, but fading it against something like euro could be a trade, right? So I'm looking at this euro sterling here. Obviously, if we bring up cable, we can see it's rallied back up to 138, which again is a bit of a resistance level, a bit of a kind of potential selling. But if you don't want to take on the other side of that dollar move and you think dollar could come down still, then a safer way to fade the sterling move might be to look at this euro sterling to try and play a bounce in euro sterling, basically, right? So that's kind of how I'm looking at it. If I'm going to play that, if I'm going to fade that sterling move, it's going to be via that. So then I don't have to take any dollar exposure, really, basically. Yeah. Okay, and then outside of that, I would say there might be an interesting setup in Aussie dollar as well. So if we look at, thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.